Okay.
Who's going to win the election, Trump or Biden?
Biden.
Oh, interesting.
It's about the economy, stupid. How do you know a politician is lying? His lips are moving.
Welcome to a new podcast with your financial wingman. Today, we're going to demystify how global financial markets work, what's happening in them, and how does it impact your money. We're going to be in conversation with Todd, someone who's been in the financial markets for the good part of 4 decades. And today, he has retired and decided to come on the show. We're going to have a great chat with him. It's going to be filled with insights on what's happening in markets today and how it impacts your personal wealth. We're also going to talk about things like retirement. What do we need to do? How can we plan for retirement? What works? What doesn't work? I'm super excited to have this chat. Let's get right into it, and I'll see you on the other side. All right, welcome to an episode of a podcast with my good friend Todd. I'm your financial wingman. Today, we're going to have some unadulterated, unfiltered fun with finance, the financial markets, your personal finance, and Dubai. So if you're ready, let's get started. Todd, lovely to have you here.
Thanks, Kartik.
Great that hand.
Great to be here.
Thanks. Awesome. So Todd has just retired, and I took the first opportunity to start picking his brain to get some unfiltered awesomeness. So Todd, how's it going? Just retired after what, 30 years of being in the financial markets?
Not 30 years, almost 38 years. And
38, wow.
it's been about 72 hours into my retirement. So
That's why I caught you early.
You got me early, yeah.
Nice. So you're a 72-hour new Todd now. Is that
Yes. I'm new to retirement and new to the Toddcast.
new to the Toddcast?
Yeah.
Love that. Awesome. So what first thoughts, first feelings after retirement? How was the feeling walking out of your organization last 2-3 days? How's the overall feeling been with you and your family?
I don't think it's really hit, because when you've done something for so long, you almost wake up. And this morning, actually, I put my phone in my briefcase because I thought I was on my way to work. At 7:30, I had to remember I don't have to go to work.
Yeah.
So I think it'll take a little while actually to kick in, to be honest.
But after working so many years, do you think not working is going to be easy to adjust to, or do you think you're going to miss it soon?
Well, I think there's always certain aspects of work you miss. I think what I'll probably miss most is the people.
Yeah.
And the people are what make up the organizations that you work for. So I'll miss that. I will miss the bureaucracy. I will miss the administration. I'll be glad that I have time to spend time on my investments as opposed to somebody else's investments, which I never really had the luxury, which I guess we'll probably speak to later on in the podcast. But I think that's the one thing. As an investment professional, there's so much information available to spend time on one's own portfolio.
Absolutely.
You don't have the opportunity to do that necessarily when you're working. And this gives you the free time to look at the PA instead of looking at
being a personal
account.
account,
as opposed to the client's PA, which is what I've been doing for most of the past several decades.
And I'm super excited to discuss that and get more insights on that. But right off the bat, you've been working with financial institutions for, as you said, 38 years. You've always perhaps been bound by what your banking institution or what your employer's view of the markets is.
Yes, the house view.
The house view, as they call it. Today, for the next few minutes, I want to hear your PV, your personal view on unfiltered, nothing holding you back. What is your current view on markets? We have so many things going on. There's so much happening in the macro landscape, interest rates, the Fed, elections around the world, and, let's say mortgages, housing. You currently live in Dubai. Perhaps you won't be here for too long. I want your unadulterated view of what you think is going on in the world and how can we prepare ourselves for what's coming.
Sure. That's a pretty broad question, but I guess I'll start as my real purview is fixed income.
Yeah.
I was head of fixed income research and strategy for a major international private bank for the last 16 years.
Right.
So I'll sort of start with there. And my view from a top-down view is that the economy, we're either in a no landing or we're actually in a soft landing. And by that, I mean, regardless, I don't think the Fed is going to be successful in bringing us down to the 2% inflation.
Okay.
And if you went back to, let's say, 2022, the real consensus view was that we were going to have this great recession.
Correct.
The Fed was going to be cutting 5 or 6 times. And because of this, this was great for fixed income, maybe great for equities also.
Yeah.
But that ended up not happening. And I think what ended up happening was inflation ended up being a lot more sticky than people thought. And that's actually what I thought, but it wasn't necessarily what the consensus was. And maybe I thought that because I'm old enough to actually have lived through the 1970s and early 1980s.
The Volcker time.
Yeah, yes, the time of Paul Volcker, where we saw how difficult it was once inflation was entrenched to actually get rid of inflation.
Right.
So I think what we're seeing now is we're starting to see the economy cool a little bit. Jobs numbers are coming down. Inflation's coming down a little bit. But we're sitting here now in the second half of 2024. We haven't hit the 2% type of range. We're not likely to. But I think it's coming down, and we're still having decent growth.
Correct.
So what does that mean, I think? I think it's still positive for equities. Equities have done fantastic over the last...
But wasn't that counterintuitive in the sense that with high interest rates, equities would not tend to do so well because their borrowing costs would be higher? Wasn't that the consensus?
Yeah, let's we'll go to that, and I'll get to that in a second. That's a really good point. But I think in the situation where you still have decent some growth, that'll be better for equities than it will be for bonds. And why is it? Because we're not right now expecting that many cuts in rates. If you went back to the beginning of the year, the consensus was that we were going to have 5 to 6 rate cuts.
Correct.
In 2024. The market now thinks we're going to have 1 rate cut. Is 25 basis points good for bonds? Yeah, I suppose it's positive in the sense that it's better than nothing.
Correct.
But it's not going to be a game changer in that sense. And right now we're sitting in July, and actually you would have been better off in deposits this year than pretty much every single fixed income asset class, and that includes credit, treasuries, floating rate loans, private credit. All of those asset classes, you'd been better off at the beginning of the year just getting your 5.2% in your certificate of deposit. Absolutely. And waiting around. So let's get back to the question on equities and rates, and that's actually a great one because as you're probably pointing out, Kartik, the really prevailing view is that higher rates are bad for equities. Why? Because the interest rate is a cost of capital. Under discounting the cost of capital, earnings by that higher cost of capital, it should end up being actually bad for equities.
Correct.
But that hasn't worked out that way, actually, which is, I think, one of the old axioms that has proven not to be true right now. I think if you take that one step forward, higher rates were especially supposed to be bad for NASDAQ type of stocks. Tech stocks. Why? Because they're longer duration, because a lot of them might not even making any money now.
So their earnings. So what that means is that their future earnings, well into the future, are going to be even more discounted for today. Is that what that means?
That's exactly right. But what has been driving returns in the S&P 500 and the broader market? Mostly 5, 6, 7 FANG stocks, and
Magnificent Seven.
Yeah, the Magnificent Seven, and that's really been counterintuitive, and that's one of the big changes that we've seen. So what you've seen is higher rates have been bad for, let's call it, the dividend-paying stocks.
Correct.
Things like REITs, things like utilities, which basically don't have any growth, but throw off dividends. So you're discounting those dividends at a higher rate. It's worse. That has actually proven to be the case, but it hasn't been approved for the NASDAQ stocks, the tech stocks, for NVIDIA and all of the interrelated stocks, which they've actually been driving this fantastic performance in the stock market this year.
But the stock market also, if you see, there's a magnificent 7 and there's a not so magnificent 493, right?
Yes.
So there's a massive divergence between these 7 stocks and perhaps the rest of the market. So do you see that gap widening further? Do you see a lot more balance coming in as far as, do you see them catching up, or do you see a little more mean reverse?
That's a good question, Kartik. I think traditionally people have always taught us, we learned it in business school, we learned through our education that you should diversify. Diversification is good. Valuation is what drives. There's mean reversion. And we've been hearing for at least how long? A year, 18 months, that these Magnificent 7 are driving, and the rest of the 493 have to catch up.
Yeah.
And so has it happened? So you look this year, and you look at some of the dividend-paying stocks or the value stocks. Yeah. They're up 7 or 8%.
Correct.
Meanwhile, the tech stocks are up 30%. So
there's a huge divergence.
And it hasn't been reverting. And honestly, I'm not sure there's any reason to. And I think there's a couple reasons for that. One, if you look at some of the stocks or that are comprised of Magnificent 7, things like Microsoft or Apple, their cash balances are huge.
Correct.
They're absolutely huge. There's probably maybe 12 or 15 countries that have bigger foreign exchange reserves than Microsoft has cash.
Right.
So investors, to some extent, are looking if there's uncertainty, if there's political uncertainty, if there's social uncertainty, these are actually sort of seen as flight to quality safe havens.
Right.
Which might seem
because of the amount of cash
because of the amount of cash they have and their ratings. Apple is a AAA rated company. Microsoft is a AAA rated company. These are the new safety. In some sense, some of these corporations are even higher rated than the United States of America, which now only has one AAA rating, by the way, left. So I think that's one of the things that has happened. A lot of people see the uncertainty in emerging markets. They see Russia, Ukraine. They see Israel, Gaza. Why not park my money in big cap stocks? And what is a big cap stock? Apple, Microsoft,
NVIDIA.
NVIDIA became bigger recently,
right
but
now, as we speak.
But Meta, these traditional are now what the big cap and driving the markets. So I'm not sure anybody is going to be in a big rush now to go buy utility stocks, to go buy REITs, to go buy banks, just because one is trading at a multiple of 40 and the other is trading at a multiple of 8.
Correct.
Maybe that just continues.
Correct.
Maybe it doesn't continue to the extent that it has.
Yeah.
But I'm not sure that everybody starts to sell Microsoft so they can buy bank stocks or consumer product stocks or whatever.
So just
Caterpillar.
Sure. Just to understand what you just said and go back to the previous point, you said that these big companies, the Magnificent Seven, are sitting on huge amounts of cash.
Huge amounts.
Right. So is that why perhaps that the high interest rates didn't affect them as much because they perhaps might have been utilizing that cash? They didn't have to borrow as much. Is that a reason for it, or are they still borrowing
no,
higher rates?
That's actually a good point. I think they built up these cash hoards to such an extent that as rates have actually risen, they're not compelled to come to the market to raise capital at higher rates.
Yeah.
So it ends up being, in a certain sense, a buffer to ride through the more difficult times.
Perfect.
And
can they also raise capital at far lower rates, even in today's environment, than let's say smaller companies or the remainder of the 493 companies? Can they negotiate better rates with banks?
They have it, and most of these companies have remained active in the capital markets. And why? Because even though interest rates have gone up, U.S. Treasury yields are higher, credit spreads have come down.
Right.
So it ends up, to some extent, balancing each other. And if companies like Amazon or Apple, if they can go out there and raise a 30-year capital at under 5%,
absolutely,
it's a pretty compelling proposition for them.
And their growth rates are much higher, so it sort of nullifies their entire higher cost of borrowing.
Yes, and it's not a real high cost of borrowing either from a historical or a relative point of view either.
Right, absolutely. So as of today, as the market stands today, as we look at interest rates, as we look at these high-tech stocks, do you think the world has shifted? We've seen a very long period of very low rates. Do you think we're in a new inflation, a new rate environment, a new market with the AI stocks coming in? Do you think that we're in a new world order? Is this the new world we're living in, or do you see us retracing back to where we were in the last decade?
Well, I mean, we're certainly not going to retrace backward. If you, from a fixed income point of view, from basically, let's call it sometime in the 1990s till 2020, we were in a long-term secular bull market for rates.
Right.
Rates went down. Probably if you're an investment professional and you're younger than about 50, you probably can't remember anything else other than declining rates. That's all you know. So, we could sit here and argue about whether 4.25 or 4.30 on a 10-year treasury is high.
Yeah.
For me, it doesn't seem high just because I can remember being in college in 1982 when it was at 10%.
Correct.
But for most people, that's probably high. I don't see us getting to the point where we were, let's say, in 2018, where interest rates were essentially zero. That's not going to happen. So that's changed. I think COVID changed a lot of things also. It changed...
What are the two big things? The people always have this thing that COVID has changed the world. So if you had to pick 2 or 3 key things that COVID has completely disrupted for the rest of our lives, what are those 3 things?
I think the one is just supply chains. I think companies and countries realize that they can't be overly dependent on one source, whether it's for outsourcing or whether it's from factories. If you were sitting in the United States and you were relying on China while China was hunkered down from 2020 to 2022, it was a problem.
Right.
And so I think a lot of them have been forced to diversify and to step back. So I think that's really the one change. A lot of, and then other ones aren't necessarily related to COVID. I think there's this we'll call it a cold peace between the U.S. and China.
Right.
I'm not sure that necessarily has anything to do with
peace
with COVID, but it certainly changed from, let's say, previous before COVID as to where we sit today, where U.S. and China are clearly in an antagonistic type of a relationship as opposed to a friendly type of relationship.
Do you think that's gonna get worse depending on how the U.S. presidential elections go? If Trump comes into power with trade wars, protectionism that's happening around the world, do you think China is going to get even more antagonistic towards the Western world?
I think the market perception is that if Trump is elected, it will be bad for the U.S. relationship with China. It'll be bad because there'll be tariffs. It'll be bad for free trade. I guess we'll see. First, he actually has to be elected before us to worry about.
What's your take on that? Who do you think is going to step into office? Is it going to be Trump or is it going to be a Democrat? I won't even say the name anymore.
That's a very difficult question, because I think what I've seen as an American is that there's a much less. It's a much more bipartisan world, and there's a lot less compromise. So whereas as people used to sort of be in the center, and maybe you were a little off the center to the left and off the center to the right, now people, the guys to the left have moved to the far left, and the guys in the right have moved to the far right.
Yeah.
So it makes it used to be, there was all this old saying years ago, it's about the economy, stupid. And so people would vote basically based on the economy. The president would sit up there, whoever it was, Ronald Reagan or Jimmy Carter, and say, "Are you better off than where you were 4 years ago?" Kind of a thing. Now it's a question of people don't seem to care about that. They just have partisan views, and regardless of what it is, whether the current incumbent is even has enough faculties to be president,
sure,
they'll vote for him anyway.
Right.
Just because it's just hyper partisan, and so I think it's very tough to because of that, to gauge what the outcome of elections like the U.S. presidential elections will be.
But after watching the sitcom last week, the sitcom of Trump versus Biden, I think that was one of the funniest things I've seen in a long time on national television. But based purely on that, do you think the American citizens or the American population saw enough of Biden to keep him in power?
I honestly, Kartik, I think, as I said, I think people are going to vote partisan. They're going to vote their heart.
Yeah.
And for them, if they're Democrats, the Democratic Party is a religion, and whether the incumbent actually has the mental acuity to do the job is secondary to their considerations. They would vote regardless of who the opposition was. They're just going to vote for him. I think that's the reality.
But do you think the American citizens know enough of what the eventual winner is actually going to do, and how is, irrespective of who wins, how is life for them going to change, or for all of us? Because whatever happens in the US has a trickle-down effect. The world is far more coupled than we'd like to believe. What do you think is going to be the biggest change that is going to come from whoever wins in November?
I think the biggest, well, I mean, you mentioned some of them before. It could be things like taxes, whereas Trump could reduce taxes. That's the typical Republican type of move. And the other could be, I think, will be on social type of things. Biden has basically opened up the borders to migrant. I suspect Trump will close those. Trump might take a different view on things like Russia, the Ukraine. He might be less inclined to throw lots of money at Ukraine. He might be tougher on Hamas than Biden is, but who really knows? I mean, that's the problem.
I mean, what they say during the campaign and what they do later is...
There's an old saying: "How do you know a politician is lying? His lips are moving." And so that's sort of the way I kind of perceive things.
Sure, excellent. So great. So if you had to summarize all of this in let's say a minute, for
geez.
someone who doesn't have an understanding of markets, right? Or who doesn't care about what's happening in the world. What would you say that all of the things that we've discussed right now, how would that impact a common man in our part of the world, let's say in Dubai, or a common citizen in some other countries, which are not directly related to the presidential campaign? How am I impacted? How does this impact me? What can I do with all this information that you've just told me?
I think the biggest thing that people can, anybody is going to be affected. Everybody's going to be affected by rates. Okay, we can talk about maybe the average common man doesn't care much about duration. Maybe he doesn't even know what it is. Maybe he can care less. Actually, the average guy in Dara, probably if I go into Dara Mall and ask them, they probably don't care.
Correct.
But they will care about things like, okay, there's rates are higher. Is my mortgage going to be higher?
Correct.
Things like that. Will I be able to borrow at higher costs? So those sort of things is important. So I think the real important thing for probably the common man is isn't their level of rates, it's their trajectory of rates and where they're going. Because we had talked about it in terms of bonds, but as we also sort of talked about, rates are important for the cost of borrowing, right?
Correct.
But they're also important in the sense that whatever rents are a function of what real estate prices are, and the real estate prices typically rates go up.
Yeah.
Real estate prices go down, except for in Dubai.
That's not what's happened here as well, right? In the US as well, rates have been going up, but property prices haven't come down.
Property prices have come down in a lot of areas,
Slightly perhaps now. But
as an owner of property in California, I can tell you they've come down from the peak. Let's say from 9 months ago.
If you want to sell it, you'll have it.
If I want to sell it, I'm not going to get what I got 9 months ago. I'll probably get more than I did 5 years ago.
Sure.
But it's not like Dubai, where it just seems to defy gravity and keep going up, day after day, week after week, without any respite.
Sure. That's a great way to segue into perhaps Dubai. And since we mentioned Dubai property, what's your take on the property market in Dubai in general? What have you noticed? What have you seen? How different is it from what it was in 2008, for example?
Well, that's a good question. I think the first time I actually came to Dubai was in 2008.
Oh, great.
That was the first time, and I've come pretty consistently a couple of times every year, so have got to see it evolve. I think Dubai is a lot less cyclical than it was, let's say, 15 or 16 years ago. A lot less volatile than it was 15 or 16 years ago. And I think there's a couple of reasons for that. One, I think in a sense, Dubai actually, and I'll use the expression, stole market share during COVID.
Correct.
Okay. And what I mean by that is, if you look at the competitors, the traditional type of competitors that you think of for Dubai and for capital places like Singapore and Hong Kong, places where you have expats going to work professionally. While Asia was hunkered down during COVID, Dubai was largely open.
Correct.
So they actually gained market share in that sense at the expense of some of these Asian economies.
Is that a sticky market share that they've gathered, or is it going to be a lot more influx?
I think Dubai was very smart. So they saw that as sort of the first opportunity. But they followed that up with, I think, very shrewdly, with a lot of social changes and social policies, things like the Golden Visa, to make it easier and more comfortable for expats to live in Dubai.
Right.
We're not at the point where there's a permanent residency yet in Dubai, but I wouldn't be shocked if that happened. If you had told me like 5 or 6 years ago, I would say, nah, it's a place where, Dubai's a place where you work for a year. If you lose your job, you have 30 days and you're gone, kind of a thing. And people leave the cars at the airport, kind of a thing.
That's a very old story. I remember that. I remember that from the 2007.
Yeah, I remember that too. That's why I brought it up. But I don't think that's the case. The second thing I think Dubai did that was very smart is all of these, we'll call them sector cities that they've developed. And by that I mean Dubai used to have the
production zone and media city.
Dubai Media City. Yeah. And one I think that's really key is Dubai Healthcare City. I remember coming here 15 or 16 years ago. Dubai didn't honestly have a great reputation for healthcare.
Right.
And I think a lot of even locals they'll go to places like Thailand for medical care. Now I think I see now they've built Dubai Healthcare City. I don't see that anymore. There's a lot more qualified doctors. They have the ability to attract top medical professionals. You go into the hospitals; they have the best, shiniest, newest equipment.
They're almost like five-star hotels now.
Yeah, almost like 5-star. Exactly. So I think they've done all of this sort of at the same time. So they stole market share, which might have been, as you say, not sticky. But then they implemented policies behind it to try to make sure that it stayed. And the last one I think that I've seen, and you probably have also, is just with the DIFC.
Right.
You've seen the proliferation of external asset managers, the proliferation of family offices that have grown by leaps and bounds. I think hand to hand, it isn't necessarily Dubai, but in Abu Dhabi, you've seen, just from what I understand, a huge number of hedge funds have now been opening offices in Abu Dhabi. And so the big hedge fund,
because they've made things easier for these institutions to set up?
I think they made it easier. They've realized that this is where a lot of wealth is being created. Geographically, it's at a good location. The one thing that's great about Dubai also that no place else has, working in Dubai, you get to catch Europe and U.S.
Geographically, it's
during your workday.
Correct.
You can't do that in Singapore. You can't do that in Hong Kong. You can do it in Dubai. You get a half day of Europe.
Correct.
And then by 4:30, 5 o'clock,
U.S. opens.
U.S. opens up also. So I think it's advantageous if you're a hedge fund and you're covering Europe or you're covering Asia, because you get it all.
Right. Absolutely. Awesome. So just to end that whole Dubai conversation, you've been here, 2.5 years now? Just over 2 years?
About 2 years.
About 2 years. Did you buy property here?
I did not buy property here, actually.
Why or why not? Or what was the thought? Was there a thought process behind it, or was it just you knew you were going to be here for a very short time?
I think that was it. I wasn't going to be here for a long period of time.
Right.
And so I've never been one to want to be an absentee owner.
Right.
And I think the other thing, Kartik, which was crazy, when I first knew that I was going to be moving to Dubai, between the time that I was looking at housing prices, thinking of moving, to the time that I actually moved, they actually went up by like 20%.
Correct. In a span of in a very short period of time.
Maybe 4 or 5 months.
Right.
And so by that time I thought, forget it. Like even in my mind, I thought, okay, I can rent here, potentially I could buy here. And then by the time I actually landed here, that was like yesterday's prices, or
that's true.
That was prices from a long time ago, kind of. So it was totally.
Pages on your web browsers were giving you false information from yesterday.
Exactly, not even just yesterday, but it was something that maybe people from Dubai are used to that, but I certainly wasn't actually.
Correct. But you came from a land in Singapore where prices are also fairly high, elevated, right?
Well, there's one key difference in that the Singapore government gets involved in managing the price of real estate. If they feel the market is too hot, they'll raise the loan to value. They'll take away the amount of land that's being developed. They'll raise stamp duty or taxes that people have to pay. So they implement measures to make sure that they don't get into these either too hot or too cool measure. Dubai, it's a completely laissez-faire. The market is what it is. And so that's, I think, one of the key differences between the two markets.
Excellent. While you mentioned taxes at some point, that's something that's been in the news a lot with corporate taxes, with other countries in the GCC and Middle East, bringing in or starting conversations about income tax. Dubai has been this haven place where, we've been sold the dream that we don't even know what taxes are, right? It's so crazy to think that some of the Scandinavian countries pay over 50% in taxes, US, every country around the world. Dubai has been that land, or UAE has been that land where your income is yours. There is now chatter that this might change, right? There are 9% corporate tax that's being incorporated as we speak. What are your takes on income tax? Just for people listening, is there a possibility that this land will have income taxes in the near future? And B is, how much should a person earning a salary here be worried about that? Is that good? Is that bad for the economy overall?
That's an excellent question. But I think if you can take a step back, let's say 10 years ago, I don't think anybody in Dubai would have thought that you have a VAT, and now it exists, right?
Right.
I mean, you've been I don't know, anyone who's been here in Dubai, if you heard Dubai 15 years ago, wouldn't have thought there'd be a VAT. It was just unheard of. They might have had a VAT in some place like Oman or something, but they didn't have one. I think as governments evolve and diversify, they need greater sources of revenue. So income tax is one of them. I should say for myself, as an American, I got to pay U.S. taxes regardless of where I live. So I don't have a lot of compassion for people crying about paying 9 or 10% taxes, but they're actually quite spoiled. But I guess there could come a point where the government looks to expand its revenue sources, and that's a fertile one. To have zero is quite something, actually.
I mean, they do collect taxes in various indirect ways as we speak.
Absolutely.
Actually, directly taxing someone's income when you see instead of $100, you have 90 or 95 or whatever UAE does decide to do, if they do. That could be a stark difference from paying 5% when you buy something, a sales tax.
No, that's true. There's no free lunch. I have noticed in Dubai that there are lots of ways that the government has its fair share of your wallet without actually calling it a tax.
Correct.
But I think to be more openly blunt about it and just calling it an income tax and you having to make a transfer payment, from your bank to the government would be something different, actually. Right. But I think it's not out of the question. I don't see why it should be not plausible at some point.
Just a question off the record, when you mentioned about you being a U.S. citizen and you have to pay taxes irrespective of where you are, wherever you are, income in the world, as a U.S. citizen, as a U.S. passport holder, you've got to pay taxes. I don't think that's true for a lot of other countries. If they live and are residents of other countries, they don't necessarily have to pay taxes. Is that a correct statement?
Someone in my office actually said that there's one other country.
Oh, yeah.
But at most, I think that there's one other country. Okay. So I think that's actually unique. And at least for me, in a bad way.
So does that then mean that a lot of people who recognize this was there ever a thought in your mind to give up your US passport and sort of, assume nationality elsewhere to save, let's say, 35% of your income?
Yeah, I certainly personally know people who have given up their citizenship and taken passports from other countries. Then the question is, what other country, if you have to work, what other country are there more opportunities in? It's not like a coincidence that the companies that we're mentioning, these big technology companies where all the innovation is happening, whether it's NVIDIA, Google, Amazon. I think in terms of the biggest market cap companies, I think 6 of the top 7 are U.S. companies. That's not like coincidental. So there are a lot of advantages. And then I guess it has to be a personal thing also. At least for me, all my family is in the U.S.
Right.
If I took it, I'd be giving up that option to go back.
So let's just say that it's a fair price to pay. What is it, 30% that you're going to pay?
Yeah. Let's put it this way. There's more, I think, to a country and citizenship than an NPV calculation. I just said, so when people ask me about that, that's the comment that I give them.
Fair enough. It was just a random question.
It's a fair one too.
So you're just talking about your journey going forward. You're choosing to move to Thailand. Is that right? Is that a financial decision to retire in Thailand?
It's a combination of financial and personal. My wife is Thai, so I think you can sort of look at retirement. You see lots of articles, online about best places to retire, and they give lots of criteria. Yeah, at the end of the day, at least just for me personally, just moving somewhere random and not having any people is a tough proposition, and that's something that I faced in Singapore. Living there 15 years, it's something I faced here in Dubai. Not having any family, not having any people. So part of it is things like moving there. It's in terms of weather, it's a cost of living. It's availability of medical care, things like that.
Right.
But a lot of it is just having family and having people there.
Right, absolutely. Because I keep hearing about places in the Far East like Indonesia, Bali, and Malaysia as good places in terms of cost of living, as well as in terms of the weather and climatic conditions. Makes it a good place for people to actually end up retiring.
Yeah, a lot of people do that, and some of the countries like Malaysia. They've implemented it. A lot of them have these schemes where you deposit a certain amount of money into the bank.
Correct.
They'll give you a longer term visa.
Yeah.
If you go more towards the Western Hemisphere, people retire to places like Costa Rica,
Correct.
which is another one of those type of places. But I think at least for those people, maybe they've lived in the whole certain place their whole life.
Correct.
I guess it depends on your perspective. I suppose if you lived your whole life in a place like Boston or Chicago, where it's cold and gray, and the winters are cold and the days are short and not much sunshine, maybe when you're 65 years old, you can just say, I need a change.
Yeah.
I'll move to Costa Rica. I'll move to Bali. I'll move. But I guess I've been fortunate, at least for the past 18 years of my career. I've lived in Singapore and in Dubai in tropical climates that are safe, that are secure, low crime. So my view of what retirement will be different than perhaps other people who are coming from a different situation.
Correct. Absolutely. So going into retirement, how long have you sort of thought, or how much planning went into your retirement? Again, financially, I just want to get the whole financial aspect of retirement. There are a lot of people out there perhaps who are on the brink of retirement or who are planning retirement. We have the whole FIRE movement going on, which is financial independence and retire early. A lot of the millennials and the Gen Zs out there have bought into it heavily. What is your advice for someone who's going to retire, or what kind of planning can go into any stage of your career as far as retirement is concerned?
I'll just start off with, since you brought it up, with the FIRE movement.
Yeah.
Anyone who I've known who's retired sort of in the early 40s or earlier, it didn't work for them. They ended up going back to work.
Because?
I think it's because they underestimated the costs of what it would be to retire. And maybe they underestimated, I'm not going to say the returns, but their ability to harvest the money that they have. Meaning, okay, their thinking might be, okay, I have $1 million. If I get 7% return on that, I can live on that. But that also means if they have that, it means, okay, I got to sell my tech stocks.
Correct.
And then what do I have to replace that kind of a thing? And
do you think 7% is a fair estimate on how much you can expect to earn on your retirement fund?
I mean, based on what we've had the last 10, 12 years, I think that's fairly conservative, actually. And you should be able to do better. But I'll say, that's not actually having to access that money.
Correct. And just pull out the 7% and keep your $1 million as it is.
Yeah.
So you're going to have, let's say, $70,000 would be your expenses. That's the amount of money you're allowed to spend.
If you're sitting there, let's say in QQQ, you get that return.
Yeah.
Now it's different if you got to actually sell that return.
Because they don't pay dividends, right? So you'll have to sell to fund your lifestyle.
Exactly. So then you got to sell. I think those are sort of the two things that people have, the FIRE type of guys.
Right.
And then I think they underestimate other things like, things like if they're 40, maybe they have kids. Maybe they have 8-year-old kids. Well, now the cost of Ivy League education or places like that is $450,000, $500,000 over a 4-year.
So we can have a whole conversation about that later, but maybe some other time.
And the cost of education is going up faster than the rate of inflation. So I think that, a lot of them have underestimated a lot of these things that they possibly thought, and they probably thought, okay, they're reading statistics as to what do you need to retire, what you should be able to get out of that. I think that's all there is, and I think it's a bit more complex than that.
So a two-part question, or you can combine them if you like. Let's say you had $1 million and you're retiring now. Today's your last day. You have $1 million saved up from whatever gratuity, whatever is your package that you close with. If you had $1 million today, and let's say you want to live 30 more years, that's how you look at it. How would you position this, or where and how would you invest this $1 million? How are you doing it? You want to combine those two, but what would one look at if they had $1 million today? How would they invest that to ensure they have a decent life going forward?
So I think one of the keys at Kartik is what I mentioned is, I think people hitting retirement have to have a good idea of what their expenses are going to be, what their outflows are going to be.
That's a starting point.
The starting point. So the starting point, I think, should be matching your outflows, not necessarily what kind of return you have. And I think sort of the way that I've approached it is, and I actually honestly don't even know because I'm moving to someplace new. I can sort of have a guesstimate of what it'll be, but honestly, I won't know until I get there, like what it's going to be. But I sort of have an idea of what I think I'll need to spend. So then it ends up being sort of a plug. So you want to have enough coming off of whatever it is, income generating type of assets, whether it's dividend stocks, whether it's bonds, whether it's deposits. But I think the other key is the mistake people make in retirement is they sell all of their equities because they think, okay, I'm retired. I need to be in safe, quote unquote, investments.
Right.
So I'm going to put it all into the bank or put it all into deposits or all into bonds. And then they find, we were talking about FIRE, maybe the average FIRE guy who's 41 years old and he retires, that guy might have 45, 50 years of life ahead of him to have to live.
Yeah.
Is his money going to be enough for half a century? He'll essentially be living a lot longer than he will be working at that point.
And inflation and everything happening these days.
Inflation happening. So there's a lot of considerations. So I think sort of the way that I've approached it is I want to have enough income generating vehicles to fund my ongoing daily expenses.
Like?
I mean, what kind of income generating?
Yeah. So if you have one portion in income generating, what is the vehicle that you're using?
I actually, in the interest of full disclosure, I'm a bond guy, and I don't have much bond investments. It's
okay. Interesting. Okay.
I have much more investments in actual deposits.
Okay. And which are yielding what 5% today?
Yeah. So I'm getting 5.3, 5.4% on deposits.
Okay.
Now, if I get 5.3 or 5.4% on deposits, I'll take that rather than buying, let's say, an ETF like LQD, where I can get 4.
Which is the 10-year corporate.
Which is the U.S. investment grade, and basically, as you said, it's equivalent to buying, let's say, a 10-year U.S. investment grade company.
Right.
So, but I buy that. I also have interest rate risk going with it. So I'm not getting anything incremental for the LQD. I'd rather just buy the 5.2%. If it goes down, I'll worry about it at that point. But right now, I've been able to just keep rolling over these deposits every 3 months.
Right. So you're hoping interest rates stay high, don't you?
I'm not hoping that they stay high, but I'm also, unlike, we talked about this earlier, a lot of the house views from going back from 2022, I didn't buy the 5 or 6 rate cuts.
Correct.
So I didn't put like all my money into treasuries or U.S. investment grade because I didn't think that was going to come to fruition.
Right.
So since you asked, I have some other type of investments in things like.
So that was the pick. That was the income. The income part.
And then I have some investments in things like dividend growth type of ETFs,
sure,
where you can maybe get, let's say, 3.5% type of yield.
But is that yield taxable? You pay tax if you have 3% yield. Are you paying a tax on that money?
It is taxable.
It's taxable because for us who are non-US residents, I pay a 30% tax, a withholding tax on any income I generate from.
No, it's not taxable to me.
It's not taxable.
It's not taxable to me as a U.S. citizen. So that's 3%.
That's 3%.
Now I've sort of accepted in my mind that any of these value or dividend growth stocks aren't going to give me the same sort of returns that I could get in tech.
Yeah. But
that's just I come from the belief that you just don't want to put all your money into one thing.
Correct.
It might be, if you're sitting here and you have a time machine, it might be easy to say, yeah, I should have just put all my money into IYW, F-Tech, whatever, the tech vehicle you want to use because that got 30% and this got 9%. But you only know that with the benefit of hindsight.
Absolutely.
And I think you don't want to have a portfolio that's positioned for just one outcome. That can be very dangerous. It might work out, but
no, especially going to retirement, you can't take that chance, right?
No, and so I can't. So while I do myself am overweighted in tech, I haven't bet the ranch on tech either, which I think. But as you said, one of the axioms that's becoming very strange is that traditionally you bought the S&P 500, you bought the market.
Correct.
Now you bought the S&P 500, you sort of bought 7 stocks, which is sort of very strange, actually.
Beats the purpose of diversification then, right?
Yes, it ends up sort of being diversification almost, as opposed to...
Worse.
Yeah, that worse.
That's a good one.
And so then I don't know what the, that's why I think at some sense you want to have at least something in other types of investments that don't necessarily correlate with it, whether it's healthcare stocks or dividend paying stocks or value stocks or something.
Right. Excellent. So that was your income. So we've talked about a portfolio that has to be created for someone. So you have an income part of it. I think the problem is, let's say you retired, you have a 5.5% or 5.3%, but that's valid for 1 year, right? That rate.
Yes.
So don't you then have an extremely high reinvestment risk? What if interest rates fall? What do you then do next year? You have to start repositioning your portfolio again. You've got to start giving it thought. Is there something that can be done? Do you suggest people who are retiring get a financial advisor? How do they go about it? Or you've been in the markets, but how does someone who's retiring, how do they go about planning for this?
I'll tell you, Karthik, it isn't just, from my perspective, it isn't just that I can get 5.3% in deposits. The other factor that I'm thinking about is that credit spreads are actually at an all-time high.
What does that mean for a common man?
So it means for the common man. So a credit spread is basically the portion of yield that's over and above what you're getting for Treasury.
Okay.
So let's say you have right now a bond that gives you 6%. 4.5% of that, let's say, comes from U.S. Treasury.
Correct.
The other 150 basis points of that will come from, quote unquote, the assessment of the credit of that particular...
The worthiness of that company. The a high-risk company, it will be...
Yes. So the ability of that company to, in layman's terms, to pay its interest and principal on a timely basis.
Got it.
So that's what. So right now, you're basically, at least, it's at a high point where it's been in the last decade and a half, where the return for bonds is comprised more from U.S. Treasuries than it ever has been.
Right.
So to me, like buying Ian now at all-time tights, it's sort of analogous to buying real estate or buying equities at all-time tights also.
At all-time highs.
Yeah, at all-time highs.
Right.
It doesn't mean that credit spreads can't get tighter. I suppose that they could.
Yeah.
But it's less of an attractive value proposition than it's been.
So you see these credit spreads widening as we go along?
I don't think they're actually going to widen just because, at least a lot, just because the credit profiles of the companies are so good.
Right.
It's just that especially for investment grade companies, to buy something, an investment grade company, and just get 70 basis points more than the U.S. Treasury,
yeah,
I'd rather just buy the U.S. Treasury at that point. Short, and that's another thing that people could do, I suppose, also, is buy short-term Treasuries.
Yeah.
And right now, my view is it, and you asked it, I don't see rates may come down, but I think they even have been. I've noticed even lately, like deposit rates have been coming down. It's not going to come down overnight. So it's not going to be like that 5% is going to go to 3.5 time. And right now we're still looking at an inverted curve. So you can still get
very barely, right? It's a very, very small inversion.
From twos to tens, it's still quite inverted. So I think that there'll still be time to reallocate whatever you have in deposits into something else, actually. But I'm not sure that something else at the moment, at least for me, is credit.
Okay. We mentioned the U.S. Treasuries a lot. I'm going to ask you a question about the U.S. Treasuries, about the U.S. dollar. Do you see any risk of the U.S. actually defaulting? Do you think that everything that's going on in the world right now, with the interest rate, or the interest component of the U.S. Treasuries, the amount of interest they're paying on the debt that they borrowed, it's going to touch $1 trillion by the end of this year, perhaps $2 trillion by the end of next year. At some point in the near future, maybe more than what the U.S. is bringing in taxes from the interest portion on the debt might exceed that. All of this coupled with the fact that Russia, the sanctions on Russia, the dollar, the U.S. Weaponizing the dollar against countries like this, with China buying so much of gold, petrodollar no longer being essentially in existence. How much do you think all of these factors at the macro level are in play? Do you think that this could be a threat to the dollar going forward?
I don't think it's going to be a threat to the dollar, just because there's really no other alternative as a world recognized store of value.
Okay.
And I think you've seen that right now. I think the U.S. is no longer even a AAA country.
Yeah.
it's a double A country. Does it really matter? Doesn't seem like it, does it? And that's the reason. It's the only world global superpower. Most the companies there are bigger than the foreign exchange reserves of most other countries.
Yeah.
So I don't see anything. It has an unlimited printing press, which most countries don't. So is the deficit a concern? Yeah, but I think at least in the short term, they'll just be able to continue to kick the can
down the road,
kind of down the road, so to speak, which is what they've been doing recently.
But they're basically putting the challenges that US is facing today into future generations,
Yes.
future presidents to take care of, or future offices.
That's exactly true. They're giving this wonderful inheritance to their children and grandchildren is what
But
people.
isn't people are the people of your generation who are retiring now? Aren't their savings, and they keep saying, so what is, I keep hearing that the medical system is broke, or the pension scheme is broke, or the social security is broke. What does that mean? They don't have enough money to take care.
I think that's it. So there have been like subtle changes. So even for myself, let's take for example, you used to be able to get. U.S. has this system which you just brought up, Social Security, and U.S. citizens will pay into this while they're working, and then once they retire, they get payouts from the system to help fund their retirement. And part of that also then is taken for Medicaid, which is a government-funded healthcare system. Okay. So they pushed back already the retirement age for which you can get full benefits from 65 to 67. I'm fully expecting mentally that by the time I hit 67, it'll be pushed back to 70 or something.
So you're never getting that money back.
So then and if you take it early, you get so much less.
Thanks.
Then like let's say you might get like $2,000 if you took it at 67, and then if you took it at 62, you might get $1,100 or something like that. So it's there's a big incentive to wait, but they also keep pushing back.
So it's a mirage basically.
Yeah, so it's sort of a mirage that you never just quite get there actually. And as I said, if when I'm 66, if I read that the age at which you can receive full benefits has been pushed back from 67 to 70, it wouldn't even surprise me one iota at that point.
Right. Absolutely. Just perhaps a take on the reason I asked you the previous question was perhaps to segue into the point where if the dollar is under strife, if countries like Russia stop trading the dollar, they say we give up our reserves in it, or China going to start depending India, these countries start trading within, let's say, within the BRICS, and they start forming their own. Do you think there could be a rise of either the gold standard coming back, or B, something like a Bitcoin coming? Do you have a view on either of those which might be worth noting?
I don't think the gold standard will come back because it didn't work when we had it, and so there's a reason we don't have the Bretton Woods exchange rate, because it didn't work. Bitcoin, I don't know. It's in its sort of infancy at this point, even though it's been around a few years. So I would classify that as an infancy.
Sure.
It's the ability to access it is growing exponentially. You can even access it now through ETFs and things like that. So I think those sort of the fungible type of currencies will continue to grow and be used in different ways. It's not going to replace the dollar, obviously. Right. I actually think that the biggest risk to the dollar is actually just falling interest rates.
Falling interest rate. Could you explain that? The falling interest rate is the biggest risk to the dollar.
So
interesting.
If people if the expectations are that the U.S. rates will go down, the U.S. dollar will be less attractive.
Correct.
Because to invest in U.S. Government bonds, people want to put their money into something where rates are already higher. Right now, the U.S. is somewhat attractive because rates are high. Other countries actually have been lowering rates faster than the U.S. But I think you see every time when U.S. Treasury goes up and U.S. interest rates go down, the dollar is falling also. So I think that's the one risk I see. I wouldn't call it a risk. Maybe it's not even an opportunity.
So is the Fed incentivized to keep rates higher?
I don't think that they're incentivized to keep rates higher. Rates are sort of a floor for inflation. I think that's the Fed's main goal is full employment or maximize employment as well as to minimize inflation.
Right.
So I think what the Fed funds rate is looked at is as a floor to hold inflation at a certain level. Right. So I think that's what it's looking. But so in a sense, it's good because if inflation comes down, then they're doing their job.
Sure.
And inflation.
But there'll be a lot of cost to that happening. Right?
Inflation is nefarious, but one of the byproducts of that might be a falling dollar also.
Right.
And although I don't know about that. We can talk about that. I've heard lots of comments since around 2010 about the end of U.S. dollar
de-dollarization.
Yeah, end of U.S. dollar primacy, and it's never happened.
Right.
Because
where else would they go? Right. They say that it's the dirtiest or it's the cleanest sock in the dirty basket.
Exactly.
Yeah.
It's the worst alternative except for all the others.
Except for all the others.
Yes. So, it hasn't happened yet.
Right. And you don't see it happening in our lifetime, at least.
I don't think so.
Yeah. Going back now to I just want to understand from just to look at personal finances, right? All of this leads. End of the day, none of this matters if we don't have money in our own pockets. So I want to understand from your point of view at perhaps the end of your career, right? What would your advice be for someone like me or someone who's in their initial stages of their career? How would you suggest, or what do we have to do to ensure that we are taken care of by the time we are 60?
I think if I could have a conversation with my 30-year-old self, which is probably what you're asking me. Yeah. I think the first thing that people should do is, and I guess listeners will be from all sorts of different countries.
Right.
To the extent that your company or your country has some sort of savings vehicle. In the U.S., we have something called a 401k. I lived in Singapore. There's something called the Central Provident Fund. Participate in those.
Right.
It doesn't cost you anything. Usually, the company matches it. In the sense of 401k, it's tax deferred.
Correct.
And $7,000 is a tax write-off in a sense. Okay. It's a deduction for me. So that's the first thing that people should do. Now, not everybody has that option.
But if you have an automatic or a direct way to save money or invest it, whether your employer is matching it or no, you should do that.
I think everyone should have the discipline to save something. I've read that some of these real dogmatic fire individuals, their goal is to save 70% or something like that, and then that way they can retire at 32 years old.
Which is scaring everyone because rent in Dubai is 70% of.
Yeah, it's really crazy. So I don't know how they could do that, but at least save something so that you get in the discipline. Maybe you can only save 1% or whatever, or 5%, but. At least do something to have the discipline so that you don't wake up one day at 49 and have nothing, for a rainy day.
Yeah. So saving it is one aspect, but as we've already discussed, the more you save money and leave it there, inflation is eating the value of that money. So save it and do what with it?
So I think were I to invest, I think people should look at portfolios as sort of maybe a core portfolio. And then a satellite portfolio.
Okay, what does that mean?
So the core portfolio, I think, we even think of it as beta and alpha portfolios, okay? So the beta portfolio, think of it as getting exposure to the market.
Okay, which is an index fund, let's say.
Yeah, index fund.
Okay.
And the U.S., if you take anything like the MSCI World or an index, it's 75% of the index.
Right.
And that makes sense, given what we talked about, that's where all the biggest companies are.
Sure.
So it's going to be.
So what would be an ETF? Someone's watching and they want to know what is one ETF they can look at.
So they can look at things like IVV,
okay.
which is the S&P 500, right. SPY,
okay.
which is another S&P 500.
Sure.
And then I think there's smaller ones. I think it makes some sense to have exposure to Europe. And there's lots of those. There's things like IEV, ECU is another one.
I'll put all of that in the description down so people can take a look at it.
Yes.
But yeah,
and then that's sort of the beta portion of the portfolio.
Okay, that's basically participating in whatever the market does.
Participating in the market.
Okay,
and then I would include even in that the fixed income funds, at least from things like U.S. investment grade or U.S. high yield. There's ETFs for those.
Right.
And I think they should have some investments in those as well too.
Is that like TLT and those kind of
So TLT would be one. That'd be like long treasuries. But it would be things like HYG or JNK, which are U.S. high yield.
Sure.
LQD, which you mentioned a few times here, which is a U.S. investment grade, which is by far the biggest portion of credit markets.
Right.
Is U.S. investment grade.
LQD. Yeah.
Yeah. So and those are sort of the beta. They're the liquid markets. Low cost to manage. And then if people want a smaller portion to quote unquote to play around with for entertainment, like millennials like yourself do, then you can buy Nvidia or AMD or the latest fad on Reddit or the cloud,
Roaring Kitty,
Roaring Kitty, or whatever it is. But but I don't think that should, at least from a retirement point of view, that shouldn't comprise the biggest portion of your savings.
So basically, discipline, do whatever can be done automatically through your employer. Have a core portfolio which is basically invested heavily in the markets, which are liquid, low cost ETFs, and then you maybe use. So what percentage would you say would be money that people should be playing around with? Let's say someone's saving 10% of their income. Let's say 90% or 80%. How much would go into?
I think people should put, depending on their risk tolerance and how clever they think they are, 80 to 90% in the beta funds, type of markets. Now, this might necessarily delve with what most of my former employers think, but I'm actually a big fan of ETFs.
Okay,
and it isn't a vehicle that was available when I was getting started or 30 years old. The best we had there was like the Vanguard Index Fund way back now. But now you can at least invest in most of the liquid beta markets for what? 4 basis points, 8 basis points, 10 basis points. Why pay a fund 1.5% to invest in the same market?
Right.
Just think about it. If the average yield on a U.S. investment grade is 5%. If you're paying 12 basis points for LQD, if you're paying 1.5% for a fund house, are they going to outperform that by 1.5% on a market that's yielding 5%? I know most private wealth managers won't, but to me it seems pretty self-evident for that. And how many, at least beta funds, actually outperform the S&P 500?
Right.
And these big funds that we're talking about, VOO, IVV,
BlackRock, and all the boys.
iShares. 10 basis points? I don't even know.
Yes, it's like you can buy an ETF now for 3 basis points.
Yeah, 3 basis points. I mean, it's almost nothing.
Which is basically $3 for every $10,000 that you invest.
Exactly. So for those funds, if they charge let's say 1.5% management fee, they got to outperform you by 1.47%
at least,
just to break even.
Correct.
That's pretty daunting, actually.
Okay, but a lot of financial experts that I've heard, someone like a Dave Ramsey, for example, who's been very popular in the US. I love a lot of things that he says, but he is big on mutual funds, so he keeps talking about mutual funds. So do you think people who are big in mutual funds, are they also paying 1.5% in fees? Because he says he's been outperforming the markets for a long time through his mutual funds. So if someone's got to look at mutual funds versus ETFs, which are easily and readily available, how do you sort of compare those two?
I think a lot of it, Karthik, is in the fine print, and maybe there are certain share classes. I don't know about Dave Ramsey. Maybe he's big enough that he can avail himself of the institutional share classes, which only charge 47 basis points,
which is still a lot more than 3 basis points.
Yes, it's a lot more. So I think funds do make sense for the less liquid asset classes.
Right.
So things like if you're investing in AT1 bonds, if you're investing in floating rate loans, so things that you don't have,
private credit, or
private credit, emerging market bonds. I think for those funds do make sense.
Sure.
But if it's just to get exposure to U.S. tech, are you going to outperform IYW, F-Tech, QQQ?
Yeah.
Maybe, but the market return is just so great to begin with that it's pretty tough to pass up.
So what I keep telling most people that follow along this journey that I've got, I've been telling them just stick to ETFs. For most people, that's perhaps your best bet. Warren Buffett keeps talking about just buying the S&P 500 ETF, and he says just keep buying that over and over and over again. He says if he had to leave all his wealth to his wife, he would tell her to invest it in S&P 500 ETF.
It's by far my biggest investment. The second one is not even close to S&P 500 ETFs. And if I could get in a time machine and go back to when I was at 30, I would have put all of it into S&P 500
Excellent.
ETFs. But who knows that, right? You don't know that, but it's still by far my biggest.
Okay.
And the only unfortunate thing about it is the yield has dropped now to like 1.2% or something, which it didn't used to be. But that's...
I love that. Personally, for my portfolio, I love the lower that the yield on that goes, the smaller tax I pay and the more money that goes into growth.
Well, yeah, that's true. But I think, as you pointed out, I think a lot of that is a function of just the composition now, because these five or seven are just priced so much that and they're not paying really any dividends. So and rightly so, I suppose.
Absolutely. I think that was a very well-rounded. Is there anything today, if you had to give, let's say, your kids financial advice, if they are listening to you based on the mistakes that you made, what is the one biggest mistake you made that you would try and prevent them, if they listen, try and prevent them from making in their careers going forward?
Honestly, I think the biggest mistake I made was not spending enough time on my personal account.
Okay.
And when you're younger in your career, or even when you're older in your career, when you're working 50 or 60 hours a week, and you come home on the weekend and you have other options like, okay, you know, I have sports, I have time with my family, I have religion, I have other avenues of personal growth, I have reading. It's tough to devote the time to your own PA.
Right.
And it might seem self-evident, but you're spending, people like ours who do it for a living, you're spending 50 or 60 hours on someone else's stuff.
Correct.
And then you're like not spending enough time on your own.
Wow.
I mean, ironically for myself, in the 3 months since I gave notice on my current employer, I think I spent more time on my PA than I probably have in the past 5 years.
But that's so incredible that you say that. Do you think that's a reason why so many people, I constantly meet people in the financial profession or the financial industry who haven't spent any time on their personal portfolio, and it baffled me initially. But what you just said perhaps might be the answer as to why that might be the case.
No, it's totally true. I can think back in my time when I was like 30. I was living in New York.
Right.
You know, I was commuting 3 hours a day to and back. So when I came home on the weekend, it was okay. I need to work in the house. I need to mow the lawn, take the kids to soccer practice. There really wasn't a lot of time, like, sit there, okay, I'm going to sit down and work on my PA and do a comparison of the funds and see their 1, 3, and 5 year performance, things that probably you should be doing. And I wasn't doing it. You know, I was as guilty as the next person, and that probably cost me. It was also admittedly more difficult then because it just wasn't the wealth of information there is now, and the information is much more automized now than it was then. But still, it's still the same thing now. You could easily now get trapped doing the same thing. You could spend your whole weekend listening to Spotify podcasts instead of working on your...
watching Netflix shows on Netflix.
Yeah, or watching stuff on Netflix. There's always something else to do that's more entertaining and perhaps...
money is something
equally as important.
Yeah, money is something more. We spend our whole life working for money, but I think such little focus, as you rightly just mentioned, is so much little focus and time is spent on actually building and growing that wealth. I think that's something that I think the listeners would love to learn from that and say that spend some time, perhaps even if it's an hour every month, or how would you, if you had to give a message out there, what would be that message?
I think that's what it is. Sit, allocate some time. Start with an hour a month to see how it goes. It may not seem so important. It may retirement for someone 30, if you're not the fire person, might seem a long time away. But life has the way of going by really quickly. Actually.
Absolutely. Thanks so much, Todd. I'm going to give you a rapid fire just to close this off. All right, a rapid fire round. I just want to know, it's a yes or no or a one-word answer for each of these. Let's see what your take on each of these is. Are you ready for that?
Sure, go
All
ahead.
right, let's get cracking. So the first one is, Would you, if you had to buy or sell real estate in Dubai right now, which one would it be?
Buy.
Excellent. Invest in cryptocurrencies, yes or no?
Yes.
What percentage of your portfolio would you have in cryptocurrencies since you said yes?
Very small. Like just myself, less than 1%.
Less than 1%?
Yes.
Okay. Gold. How much of your portfolio would be in gold?
I would have 2 or 3%. I don't have any, and I regret it.
Wow. Okay. Which country would you most invest your money right now? If you had to invest in one country in the world today, where would it be?
My own country, the US of A, of course.
US of A. All right. Is that an emotional decision, or is that
It actually isn't an emotional decision. We had at my most recent former employer, I won't mention the name, one of our CIOs, former CIOs, who wasn't even an American citizen, he was always overweight to the U.S. And his reason was always, this is where all the innovation,
right, absolutely.
This is where innovation happens. This is where technology is expanding. This is where innovation is fostered and developed. And this shows up in the companies and their performance. And that was his whole rationale, is that there's an environment that's been created to foster capital creation and put that towards innovation and technological development. Pretty simple.
Sure.
And it actually has worked, and that's totally been the case, actually.
Absolutely. I'm going to go back to my rapid fire.
Okay.
Who's going to win the election, Trump or Biden?
Biden.
Oh, interesting. Okay. India is set to, some Goldman Sachs report said that by 2075 or some number like that, India will overtake the US in terms of GDP. Do you see that happening in your lifetime?
I won't be alive in 2075. So,
do you think in my lifetime India will overtake US as the number one economy in the world?
I mean, in terms of just GDP,
Yeah.
Quite possibly.
Interesting.
That's not a one-word answer, but
Sorry?
It's not a one-word answer.
Yeah, sure.
So I'll get
That's
one word
fine.
answer. Plausible.
Plausible. Fair. Thank you. Rates 1 year from now, where will they be?
I would say the 10-year will be at 375.
375. Excellent. Hopefully before that, I'm going to have another chat with you at some point. Maybe you'll be doing it from a nice hill in Thailand or a nice island in Thailand. I might be right here. Thank you so much for your time. I hope you enjoyed that conversation.
My pleasure. Went by quite quickly.
Excellent. I don't even know what time it is. I don't know how long this is, but thanks so much, Todd. We're going to come back and hold you on to that 3.75 call when I see you next.
And if it doesn't work out, I'll change the recommendation or the forecast.
Of course you will. Of course you will.
Like any economist.
Lovely. Thanks so much, Todd.
Sure.
Pleasure having you. Thanks, and I'll see you soon.
Yep.
Cheers.